Hello, everybody. Kirk Spano, Investing 2020s on Saturday, January 2024. We are going to talk a little macro, but then we're going to talk about screening for stocks, how I find ideas, and I'm going to cover a new feature stock list that I actually used the term 5 or 6 years ago in an interview. Now that I'm a grandfather, I think it makes more sense to introduce it as an official list. So we'll get to that in just a minute. Let's start with the macro, though. Here you can see on the screen the FFTT tree rings report from Luke Rumman and Forest for the Trees, FFTT, that I've recommended. If you have a spare $1,200 a year to spend, you'll probably want this. Otherwise, I'll just talk about it for you. We have talked about, or I have talked about, how the dollar drives asset prices. And we've tried to make it very clear to you, different charts, different historical measurements to make it understandable that if the dollar goes up a lot, there's pressure on asset prices. And if the dollar drops a bit, then there's relief from that pressure and asset prices rise. Typically, when the dollar rises, the U.S. stock market can still go up. It just generally won't go up as much. And if there are recessionary indicators, then you get your corrections. That has universally played out since the 1950s. So a strong dollar combined with recessionary signals leads to a stock market correction. Valuations are what people like to talk about, but in the short term, valuations don't matter much. In the long term, they do. In the intermediate term, that 3, 4, 5-year window that I look at is where the valuations really come into play. Over the 1 and 2 year period, you're generally just looking at the emotionality of the market, how it feels. Does it want to invest or does it not want to invest? And in the long term, the valuations play out as the business performs, as people discover different ideas, as they go through their emotional gyrations, they come to hold generally the better stuff. Now, there is an element of gambling and investing that a lot of people get sucked in by, and that ends up leading to them buying high and selling low, which is the opposite of what you want to do. So when I talk about macro, I'm trying to figure out what the next mood in the markets is going to be. Because if I can front run the next mood, if I can understand tomorrow's narrative today, the narratives being incredibly powerful on moving markets that drive questions like, why did that happen today, which is usually answered weeks or months in the past, then I can get an advantage on the market. I can have an edge. I can do things looking forward 3 months or 6 months or a year or two and get in front of the next emotion-driven rally that's fueled by the trader narratives that are designed to support their book, right? So if the trading groups make a trade, what is the next thing they do? They talk about how smart they are and why that trade should play out the way that it does. And they don't say, hey, this is my trade, you should buy it too. They usually go on the attack against anybody who's not in the trade. And they use a sort of psychology to drive people to the point of just emotionally clicking the button. Click, 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 click. I'm going to join too, because right now it's going up. Well, once a lot of people get into a trade and you see that parabolic move in the chart, the narrative continues, but the narrative makers, the hedge funds that feed the trading rooms, and then the trading rooms that create the zealots, they're selling. The hedge funds are selling, and the key people in the trading rooms start to sell. And then a day or two after they sell, they say, oh, I'm starting to sell this. But you don't have to. It's probably still a good trade. I just started trimming, because I had some profit to take. And then people get trapped. When I cover things like FFTT, I'm trying to figure out tomorrow's narrative. And I think that we nailed it pretty well here lately. So what have I been talking about? The dollar. And suddenly there's governments and central banks all over the world concerned about the dollar getting stronger again. We've been having a bit of a strong dollar moment in January, not real strong, but it stopped going down, and that created some resistance in the market. People want to say that that's valuations mattering. But what happens if the stock market goes up 20% again this year? Then what will they say about valuation? I think that's a pretty interesting question to pose, especially in a momentum-driven market on the upside or on the downside. Let's figure out what tomorrow's narrative is going to be. And one of the things that I've talked about is that at the next Fed meeting, I think we're going to get nice Jerome Powell, nice Jay Powell, and he's going to talk about dialing down quantitative tightening. He's already hinted at it twice. I think he's going to be a bit more explicit. Right now, the Federal Reserve is sucking $1 trillion a year out of the financial system. They have used the majority, not all, but sometime this year, they'll be out of the fund that supports the reverse repo market. That's something that we talked about 3 years ago when they put it in place, that they created $1 trillion reserve fund, and they've almost gone through it. They'll just recharge it, right? They'll just plug it in and recharge it. But one of the ways they can do that is to reduce the quantitative tightening. And I think they are going to cut the quantitative tightening in half from $1 trillion this year to, because they'll have to scale into it, or because that's how they'll choose to do it. I've always thought, do it over 2 months and be done. But, they like to create these glide paths because emotionally we can't handle anything else. But if they get quantitative tightening down to, say, $500 billion this year, and then they do a special facility, don't call it QE, of say $500 billion to shore up the bank balance sheets that are being damaged by commercial real estate, suddenly you have a year that went from sucking $1 trillion out of the monetary system to sucking nothing out of the monetary system. And all things being equal, no money coming out of the system should just allow the conditions that prevail to play out. Well, what are the conditions in the market right now if there's no manipulation by the Fed to either put money into the system or take money out of the system? Well, the condition that prevails is that there's a lot of money out there. Trillions and trillions of dollars just sitting on the sidelines in money market accounts all over the world. 6 trillion in the United States, when normally there's only 2 or 3 trillion. So there's 3 or 4 trillion dollars that could go into risk assets. Now, that won't all go into stocks. But as people start getting lower rates of return on their money market accounts, they'll start repositioning that money. I think about half of it will go into real estate. So 1 or 2 trillion extra dollars going into real estate. I know, and remember, the money market accounts aren't just mom and pop, it's family offices and hedge funds and things like that too, private equity firms. You're going to see a lot of development that stalled last summer come back online this summer. I've talked to you about a couple of private equity real estate deals that I'm involved with that we were trying to raise money for last August and September, and we just put everything on hold because interest rates were too high to get a 15% internal rate of return. If we can get a mortgage for under 6%, suddenly we can get a 15% internal rate of return on our money for something held by real estate. And that's what's coming, a flood of real estate development. And what's interesting here is a lot of it is going to go into buying the commercial real estate out there that's in trouble and then redeveloping it. There's already, and I threw this chart up somewhere, a record number of apartments coming online this year. And your vanilla investors in the private equity space, family office space, your developers, they want to build apartment buildings because they look at it as the highest return on their money. I think the smarter move, and I'm going to talk to a couple of firms that I talk to, is to do condominiums and then own the management company. Because then you can get the recurring management fees, build in a 15% margin, and recoup all your money with a profit for selling the condos. It's more money up front, and you still get your 15% annualized return because you own the management company. Now, is it a completely passive investment at that point? No. And that's what a lot of investors hate, is they prefer the passive investment. I'm going to try to convince at least one firm, if not both, but one in particular, that, hey, let's put together a management firm structure. Let's find the 5 key people that can manage properties, sell the condos, recoup all the money with a VIG, and then collect a recurring stream of income on top of that forever. We'll see how convincing I am. But the reason I think that is with so many new residential units coming online, if you've been watching the news on immigration, it is clear that there is 10 to 20 million people in the country right now that are going to have to be given a pathway to citizenship. Even the Republicans are on board with that, at least the mainstream Republicans, the couple that are left. Well, then they're going to shut down the border pretty hard. So if we're going to have 10 to 20 million new people in the country over the next decade, I mean, they're here, but they become naturalized, they become citizens, they need places to live. And the existing rental properties are probably enough, but we're short on ownership, especially since big institutional investors have bought up, it's like 6 or 8% of all the homes in America suddenly. And Congress is trying to put something together that says that they have to sell them. The ownership of single family homes, they're going to take away tax breaks. They're going to do something that basically forces these institutions to sell those homes back into the market, which is good. You've heard me rail on Airbnb, taking rentals out of the market. So what we're going to see over the next several years, probably through the end of the decade, maybe into the next decade, and this plays into the demographics of the boomers retiring and then starting to die sometime next decade or decade after, is we need to build up the housing inventory, and that's going to be pretty good for certain stocks. Companies that build, companies that maintain, companies that are involved in the technology of real estate. So this big picture view, I think, is coming into focus for a lot of people, but they're still way behind in years for what's really coming. Combination of more houses, EVs hitting an inflection point in 2026 and 27, because of all the technology, supply chains, and laws that hit at that precise time. And the Federal Reserve starting to finance it again this year by no longer taking money out of the system. Now, does that mean stocks are going to go straight up? No, because that's not the narrative right now. And valuations are sort of high, so maybe they'll use valuations being sort of high on some stocks to try to talk the stock market down 5 or 10% in the next couple of weeks or next couple of months. And if we don't get nice Jay Powell in a couple of weeks, that means that we probably have to wait for March before the Fed starts backing off on things. Tom Lee said in an interview the other day something that I told you months ago. I think the Fed is backing off by March. He agreed with me. That's a pretty good guy to have agree with you. I think that they start winding down quantitative tightening in March. I think they do the first interest rate cut in March. And if there is more than one bank that is crying uncle at that point, it'll be a big cut. It won't be a quarter point. It might not even be a half point. It might be a full point. Frankly, I think a full point would scare the hell out of everybody for about a day and a half. And then the smart money would start piling in. Because it seems like, and you tell me how you feel, everybody is waiting for that moment to get back in. As soon as my interest rate on my money market isn't paying me enough, I'm jumping back in. So Tom Lee makes it look like this. This is over at FS Insight, which about a dozen of you subscribe to. Again, this is another super expensive subscription. So they kind of see the shape of the market like this year. I do too. But I think the correction is going to play out in the next 6 or 7 weeks, 8 weeks. And it might even be faster. We might be done correcting by the day of the Fed meeting. Was that February 1st? 2 weeks. Forest for the Trees mentions 13 days until Auntie Yellen ramps up the economy again, because she really is kind of in charge. Remember, I've told you, and everybody knows this, Jay Powell is not an economist. He's a super administrator that listens to economists. And pretty much how Janet Yellen has gone is how he's gone. Janet Yellen, pretty staunch Democrat. I don't think they're going to wait very long to start putting money into the system. And there's ways that the Treasury can start doing it early, adjusting certain requirements. So in this environment where I expect liquidity to jump, our chart that shows the jitterbugging of the stock market right now, and if this correction gets in here, which is only about 5 to 10% lower, then you get your next rally up. Because we already had our bear market, right, back in 2022, correct. We're in a new bull market. You're going to want to buy the correction. We're going to see S&P 500 at 6,000 by next year, pretty certain of it, because the liquidity is going to be good. And then when people see at the end of the year their statements are good, maybe people are even checking quarterly statements nowadays, right? There'll be a FOMO too. And at some point when the S&P 500 does that weird parabolic curve back up, we're going to have to take profits. But the favored sectors are probably going to keep doing well. So over at Value Line, which I also subscribe to, I haven't shown you Value Line in a couple of years, I don't think. They have their rankings of their various industries. I've never really done much with beverages, but there's some big winners in beverages. I talked about utilities recently. building supplies I just talked to you about, right? Certain tobacco actually looks pretty interesting. I'm not really a tobacco investor, but Imperial looks pretty interesting, and Altria seems to be making a pivot that seems like it's going to work. It was a very difficult pivot, so I avoided Altria for years, and it went down for years, and not so much anymore. So we'll see what happens there. It's not a company on my list. I'm just saying there's some pretty interesting things going on in certain companies. The semiconductors should be soft for a quarter or two, but that will represent an opportunity to buy. I believe Shooter is going to talk about semiconductors in the major markets report that we're about to do in a couple of minutes. So over at FS Insight, this is his granny stocks report. He calls them granny stocks. Well, so my new list is going to be called the Kirks of Grandpa stocks. And this new list is designed to give you stocks that are below average risk and have companies that have just incredible balance sheets. So this is going to be our low risk stock list. And on this list, I've decided to just formalize this. We are going to use our four-step process. What secular trend is the company benefiting from? Is Fed and government policy neutral, positive, or negative for the company? You won't find any negatives because then I won't invest in them. What type of fundamentals does the company have? Do they have a moat, meaning that it's difficult for anybody to really compete with them? Do they have a fortress, which makes it almost impossible to compete with them? Or do they just have a walled garden, meaning that they have a lead, but maybe somebody catches them? So these are all wide or slight moat companies, right? A minor moat, right? A moat that can be swam across. I'm calling walled. A moat where the sharks probably eat everything, or the alligators eat everything, right? I think most usually have alligators. I guess unless they're seaside, then maybe they have sharks. I don't know. Like Nvidia, as an example, it's going to be almost impossible for anybody to knock them off their throne anytime soon. But we know that Intel is going to start competing with them. Apple is competing with them a little bit for their own stuff. And that's right. They're half the cell phones on the planet, so that's a big deal. Then you have your fortress companies. Ton of money, and very, very hard to even fathom anybody competing with them in the next 5 years in what they do. Bristol Myers is one of the companies that suddenly popped up to the top of the list, and I've been talking to you about healthcare for a month or two now, right? We've talked about Pfizer. I think Pfizer has more upside, but Bristol Myers is safer. And I'm just pulling different research, right? Borrowing some of Lee's ideas, using Morningstar to find what they have to say. Value line I showed you a second ago. Bar chart's pretty neat because they're one of the only screening systems that will segregate by what index a company is in necessarily. And I like that because one of the things that we want to do is for the mid caps, we're looking for the stocks that will be jumping up to the S&P 500. So some of these companies we are going to be interested in. And I'm not done yet. I have about 10 more mid caps put in there and about 7 or 8 more large caps. So it'll be around 30 stocks on this list, and it's all going to be large and mid caps. The small caps will either be on the dividend list or on the growth list because smaller companies do carry a bit more risk. None of them have moats yet. They're growth stories. Most of these stocks are already on the very short list, which is just the screening universe, but I'm adding a few. I'm stealing other people's ideas, appropriating them. I'm freeing them. I'm freeing other people's ideas, the ones that I like anyway. And this will be published tomorrow. I'm going to get my grandkids in about an hour and a half, and I'm going to take them to their home, and I'm going to show them how to make pizzas today. So I will not be finishing this today because after the grandkids, we got the Packer game. Tomorrow is a work all day, and I will finish Kirks of Grandpa stocks, and they will be published on both websites. Margin of Safety, which is where I write things initially because it automatically tickers everything for me. I don't have to enter them. It just pops up. And then I'll copy it over to Fundamental Trends 5 minutes later. So these are some of the stocks that we're borrowing from. Taking a look at FS Insight. I don't actually love his small and mid cap picks. So there's a couple in here that I liked. E Plus. That's one of the companies that's going to make it for us. I really like these guys. I think that they got a lot going for them. So for people who haven't been in the chat room, I again encourage you to go into the chat room or the investment group chats over at Fundamental Trends. Teresa continues to do the weekly summary. I want to talk about Ametis just a second. So the remainder of the calls that we had expired, worthless. For those of you who sold at $1 and $2 and $3 like I did, really you didn't lose any money and you probably made a little bit of money. I think what we learned is that the volatility in these small caps and micro caps is so incredible now. I mean, it's way more than it used to be. And again, it goes back to the trading narratives and scaring people and making them emotional. Now, 98% of my holding in a Metis has been stock, selling puts, buying stock. So here we are trying to figure out what to do with Metis. And what I will tell you is I know that there's a possibility that management would come in and buy shares because we talked about it last May. And because they had so many announcements coming, they didn't buy shares. I'm not so sure that the Metis management isn't going to buy shares this time. I've asked them to. I don't know if they will. I think that with the Fed loosening up, I think that micro caps and small caps are going to do very, very well. Tom Lee, and I included this chart over here. It's got a different title at Fundamental Trends. Tom Lee included this chart. It shows what happens when the PE ratio of small caps gets too low. They go on these incredible tears. And the last time that they were so undervalued, back in the dot-com crisis, dot-com crash, small caps outperformed for 12 years. I'm not so sure we're going to get 12 years of small caps outperforming, but it wouldn't surprise me if small caps outperformed through about 2028 or 2029. So 6 or 7 years of outperformance. And I think the big outperformance will come as the dollar drops this year, and then as FOMO hits them. And then I think the outperformance narrows. But right now, Tom Lee is saying that you could have a 50 to 60% up here in small caps in general, which means that some of our stocks could double or triple. So all the data supports what I've been telling you for the past year, which is you need to be buying small caps because they're getting just too darn cheap. And the indexers, if nobody else piles into those stocks from the institutional and smart money side, which appears to be the pivot that they've all made, you're starting to see the big money, the smart money, go in the small and mid caps. So they'll get a year of outperformance, and then the public will notice it. They'll be like, oh, maybe I should add 10% or 20% of my 401k contribution to small and mid caps. I wasn't doing that before. I was just putting it all in the SPY. So that's how it follows. The first year is the smart money getting in, which I think has been going on. And the second and third year is retail drifting in and then piling in. That's my story. It's been right in the past, so I'm sticking with it. All right. Everything is up over here at Fundamental Trends, same as is a margin of safety. I know there's some angst about the 20-minute difference and when things get posted. However, Kirk's of Grandpa stocks will be out tomorrow, and I will be converting the punch card stock lists into the exact same format. At the bottom of the page, I'll have a what to buy this month. So we are going to update the stock lists every month with what to buy this month. So you'll have a short list of 4, 5, 6 stocks a month probably on each one of these that are ready to be bought. Some months there will be more than others, right? There will be certain months where we're like pretty much we're sellers. That happens about once, maybe twice a year. And there'll be 3 or 4 months a year where we pretty much just sit on our hands. And then about the other half of the year, there's usually good stuff to buy in different spots. So I'll keep using, I don't know where it went here. I'll keep using Value Line to know which sectors are taken off. We'll keep using other brainiacs to borrow their best ideas. We'll screen it all together and we'll come up with our best list. Kirk's of Grandpa stock list, or the punch card high dividend. That's what we're changing the name to, high dividend stocks, or the punch card growth. All right, I'm going to let you go and reset for Shooter and bring Shooter on. Make sure you read all the articles coming out in the next 2 to 3 weeks. The next 2 to 3 weeks, I think, will be important. We'll know come the Fed meeting if we have another month of correction coming or if things are going to start ramping up. My guess is we get some jitterbugging for the next 2 weeks. Probably going to be selling some puts. Look out for the retirement income options update. It's already half done. And I think that you should be working your way back to getting fully invested as soon as we get the all clear from the Fed.